Hi again. Welcome to Chapter 3. Chapter 3 is our financial accounting review chapter. In this chapter, I'm going to remind you that how important financial accounting is for finance and go over a couple of important shortcuts to financial accounting that we use in finance. So let's get this show on the road. Okay, so first up, why do we care about financial accounting? You've already suffered through a whole semester of financial accounting, and can't you just be done with it? Well, it turns out, no, we can't in finance. Warren Buffett is famous for a lot of things, but one of the things he's famous for that's very germane to us is for saying that financial accounting is the language of finance. And that's actually true. So we do need to use financial accounting through the term this semester. So I am counting on you to remember your financial accounting and build on it. Financial accounting is, of course, a prerequisite to this course, and it's a prerequisite because we need it in this course. Okay, so I'm going to show you now a couple of accounting shortcuts that we use in finance. The first one is we try whenever we can to maximize the use of journal entries. So in other words, if something important happens, we don't want to make a whole new set of financial statements, takes too long, et cetera, et cetera. So we just want to write down the journal entries if possible and think about it. If we have to make new financial statements, we will, but hopefully we won't. Just as a quick aside, in finance, if you become a finance professional, probably your most precious asset is always your time. There's never enough time to do anything. Well, not anything, everything. So we're always trying to see how we can make best use of our time, and this is one way to do it. The second shortcut that we'll be looking at is simplifying the recording and presentation of PPE and depreciation. Okay, so starting with maximization of our use of journal entries, let's see how this works through an example. Let's consider a leveraged buyout of West End Advisors, LLC. And West End Advisors is my firm. It's a financial consulting and asset management firm. Customers include individual startup companies, family offices. It was founded initially with two members who were the owners of the LLC, and each member owned 50% of the firm, one share of stock, total of two shares outstanding. Member one is CEO, CFO, president. Member two does sort of nothing, is kind of a passive investor. And this is all actually sort of true how it happened. Member two was not a lazy, good-for-nothing slug, but member two had a reasonably big name in the finance and accounting industries, which lended a lot of cred to the firm when we were starting up. Okay, so let's consider a hypothetical balance sheet for West End Advisors at the end of its first quarter of operation. So here we've got it very simple. We're starting out in this firm working part-time, et cetera, et cetera. So at the end of the first quarter, we have $8,000 in cash. Notice everything is thousands here unless otherwise noted. We had accounts receivable of $4,000 and net PPE, which we'll learn about very soon, of $5,000. So our total assets were $17,000. We had some liabilities, accounts payable for PPE. The way that worked was that we charged a bunch of IKEA furniture and things like that to the company credit card. So that counts as accounts payable, but it was actually for PPE. And owner's equity looked like this. We had paid in capital. So we each put in $5,000 when we started the firm. And in the first quarter, we had net income of $4,000 and we paid ourselves dividends of $2,000. So our total equity was 12. And so you can see, as always here, we have total assets is equal to total liabilities plus total equity. That's true, as we know, at all times under all circumstances. So let's go back in time and let's say that at the end of quarter one, everything's been great, but the management team wants to reduce the number of owners. And the way that is going to work is that the firm, not member one personally, but the firm is going to offer to purchase member two's share. And there is a negotiated price for that of $6,000. So after some negotiation, member two agrees, and the firm is going to finance this transaction by taking out a loan for $6,000, going to our local Citibank branch and telling them what we're up to, what the future looks like, and getting a loan of $6,000. That loan goes to the firm. And when this happens, the firm buying back these shares from some of their owners is called the share buyback firm, and the transaction is called a share buyback. And when a firm funds this buyback with a new loan, it's called a leveraged buyout. So you can have a share buyback, buying back shares of your firm with cash that's already on your balance sheet, and that's nothing wrong with that. That's a normal share buyback. If you go out and get a loan, like West End did here, if the firm goes out and gets a loan to fund that buyback, then it's called a leveraged buyout. So we want to know now, what are the implications of this leverage buyout for West End's balance sheet? And we want to do this without having to go through all the rigmarole that we learned in financial accounting to create a whole new revised balance sheet. So let's see if we can do that. So we're going to start that by focusing on the journal entries for the buyout. And quick reminder, as far as journal entries go, an increase in assets is a debit and a decrease in assets is a credit. And for liabilities and equity, it's just the opposite. An increase in liabilities or equity is a credit and a decrease is a debit. And also I've got this expanded here to remind us that equity is made up of what is in the equity bucket is revenue, expense, paid in capital, and dividends. All right, so with that in mind, really two things happen with this leverage buyout. Number one, West End has to go out and get the loan. And then number two, they give the proceeds of that loan to member two, and member two gives the firm his single share. So to take out the loan, the first thing we're going to have is DR cash of 6K. And what I like to do with these journal entries is I like to remind myself if that's an asset, liability, or equity. So cash is, of course, always an asset, and DRs have to equal CRs in all these transactions. So I need something else. So what else happened? Well, the firm got this loan liability, okay, and it's going to have to pay that back of 6K. So let's note that as a liability. So that's the first thing that happens in this leverage buyout. The second thing that happens in this leverage buyout is that member two gets a pile of money and he surrenders his share. Okay, so this is going to be CR cash. And we don't care in finance if you put your DRs first or your CRs first, does not matter. We just want all the correct information. Okay, so the cash from the firm's perspective flew out the door, and that cash account is still clearly an asset account. And now what's the other side of that? Well, the way to remember this is when you issue shares, that's paid in capital. The cash you get when you're issuing shares is paid in capital. Okay, and when you buy back shares, that's also paid in capital, but instead of being CR, increase in paid in capital, it's a decrease in paid in capital, which is a decrease in equity. So that's going to be a DR for our, capital, paid in capital, or commonly abbreviated as PIC, and that's going to be 6K. So now our debits equal our credits, okay? And I'm just going to put under here the firm burns the share, the retrieved share. Okay, so when you do a transaction like this, the way to think about it is that when you're buying back shares, you get those shares, you throw them in a burn barrel, and you burn them up. And I know some of you accounting majors know that in the real world, it's a little bit more complicated than that. You have treasury stock shares and all that jazz, but effectively in finance, that's, well, not even just in finance, effectively, that's how it works. And it's a nice way to think about it that will always work in finance. So you do a share buyback, you reduce the total number of shares outstanding by the number of shares that you retrieved in the buyback, and think of it as burning those shares. Okay, so now we're ready to say what's the net effect of these two things. It looks complicated, what's going on, all that stuff. But I think if we look at 1 and 2, we can say, hey, this cancels out with this one because we have cash going up by 6,000 and then cash going right down by 6,000. So the net effect of 1 and 2 is the loan liability up by 6K, and the equity, remember paid in capital is a part of equity, down by 6K. All right, so this is debt, important to note. And now I think we have kind of a good handle on the implications of this transaction, this leverage buyout. So let's see if we can summarize now, just looking at those two journal entries, everything that's important about this. So assets are unchanged, okay, and debt goes up by 6K and equity down by 6K. So when a firm does something like this, when you do any kind of transaction, leverage buyout, whatever, it doesn't matter, that has the net result of assets unchanged and debt goes up, equity goes down, or vice versa, equity goes up, debt goes down. That's called a debt for equity swap. Okay. This, by the way, is the type of transaction that private equity folks are involved in all the time. So if you're interested in private equity, this is something you should definitely know. All right, so now that we understand clearly what's happened here, let's see if we can say anything about the implications. Does this buyout make the firm, WA, more risky or less risky, or does it have no impact? Well, let's take a look. So debt's increased, debt has to be paid back, and you have to pay interest on that. Equity has gone down, and remember with equity, there are no promises in equity land. A firm can give shareholders, equity holders, dividends, but it doesn't have to. There are no promises that it's going to continue to. So I think on balance, this definitely made the firm more risky. Okay, because debt okay, there's the reason why it's more risky is this has increased the debt, has to be repaid, and interest has to be paid along the way. And for why or why not, we just explained it. So we say see above. All right, so you can see very, very quickly there, without having to go through the rigmarole of making a new balance sheet, comparing it to this balance sheet, all that stuff, we were able to figure out the implications of a fairly sophisticated transaction very, very quickly without too much work. Okay, the second shortcut that we use vis-a-vis accounting and finance a lot is we simplify the recording and reporting of PPE and depreciation. And what we're going to do oftentimes this term is we're going to use what we call net PPE instead of PPE and accumulated depreciation. It's just going to simplify things for us, and it does not change the economics of what's going on at all. It doesn't misrepresent the economics. Okay, so let's dive back into our memories, happy or horrific, whatever it is about financial accounting, and remember how PPE and depreciation work the way you were taught in financial accounting. So initially, when you purchase a depreciable item, any kind of property, plant, and equipment, short for that is PPE, we would add this PPE PPE asset at cost, and we'd create our accumulated depreciation contra asset account. And the contra asset account, if this is our property, plant, and equipment here, this big shark, the little pilot fish here is our contra asset accumulated depreciation account. It always lives with the PPE account, and when that PPE reaches the end of its useful life, the pilot fish count, the contra asset account, disappears as well. All right, so then we go on to what you've learned in financial accounting. We want to, as the years go on, record the reduction of useful life in our PPE as debit depreciation expense and credit accumulated depreciation. And we never make a change to the PPE account until, of course, the PPE comes to the end of its useful life. And so the balance sheet representation of this is always going to be PPE at cost minus accumulated depreciation equals book value. So that's what you've been doing on your balance sheets, and here's how you have been recording the wear of PPE. What we're going to do is we're just going to jump right to book value of PPE, net PPE, without all this rigmarole of the contra asset account, et cetera, et cetera. So it's going to be much simple and easier. So here's our finance shortcut method for tracking PPE and depreciation. So instead of working with PPE, we're going to work with net PPE, and net PPE is just defined to be the cost of an entity's property, plant, and equipment less the amount built in there, less the amount that its useful life has declined. So mathematically, net PPE is always equal to PPE minus accumulated depreciation. And that's just going to simplify things for us a little bit. So let's do an example seeing how we could record things using this finance shortcut of net PPE. So let's look at a realistic-y type of example. Let's look at Green Car Company. I've abstracted this, but this was based on a small maker company outside of Pittsburgh called Green Car Company. And Green Car Company, they've gone out of business now for a lot of reasons, but they were successful for a while back in the day when VW had a lot of used diesels that weren't worth much because it turns out they were lying about their gas mileage. So Green Car Company's business was to buy these used diesel VWs, which they could get at a very low price, and convert the engines to 100% biodiesel and then resell them at a higher price. And that was actually a pretty good business. They were sort of brought down by the fact that the supply of these cars ran out after a while, and it's actually hard around the country anywhere to get 100% biodiesel, highly specialized fuel. Okay, so what was Green Car Company's engineering challenge? Yes, I know this is a finance course and this is an accounting chapter, and what are you doing talking about engineering challenges? Well, I just want us to think realistically a little bit about what's going on and think creatively about how we might solve this. So here's the deal. If we draw a graph of temperature on the x-axis versus viscosity of fluid on the y-axis, for diesel, we see it's pretty much flat, so it's not really affected by temperature. Viscosity, by the way, is a measure of the stickiness of a fluid. So something like honey is very viscous, motor oil is fairly viscous, water is not viscous at all, right? No stickiness at all with water. So diesel is down here like water, irrespective of temperature. And what we see with a typical biofuel, we've got sunflower oil here, but it's typical of most biofuels, is as the temperature gets lower, it gets more and more and more viscous, which is a problem because then you can't pump it around through tubes to get it into your fuel injectors and et cetera, et cetera. So that's the engineering challenge for Green Car Company. So there are basically three ways to solve this problem. One is you can have larger tubes, right, that can handle the more viscous fluid. The second thing that you could do is keep the temperature high in this range, no matter what. And the third thing you could do is try to chemically change the chemical properties of this sunflower oil so that it had a nice flat curve like diesel. So that clearly would not be possible for Green Car Company. And Green Car Company used a combination of keeping things warm and also increasing the size of key things like their fuel injector ducts and stuff like that. Okay, so let's say a green car company is getting a CNC mill, which they're going to use to modify the injectors on their diesel cars, and they purchase this on 12/31/20X0, last day of the year. Costs them 50,000 installed. It's got a 5-year expected useful life, no salvage value, and green car company is using straight line linear depreciation. So that means they're going to expense 20% of this 50,000 cost in every year. All right, so that's the story. So what we want to do is we want to record the where on this PPE using the finance shortcut method with net PPE, okay, and we'll think about depreciation too. So let's start with the purchasing of the mill here. We've got our 12/31 in the year X0, buy the mill, pay cash. So clearly that's going to be cash flies out the door, CR cash 50,000, and they get this asset, right? This is clearly, this is an asset, right? And the cash is also an asset. So debits equal credits, everything looks good. So instead of saying they get PPE, we just say they get net PPE. It's going to make our life a lot simpler. Trust me on this. Okay. And now let's go a year out. Okay, and they're going to do financial statements for the next year, year X1. So what's happened? So the life of the mill has decreased by 20%. So they need to reduce the book value of the mill by 20%. And how do you do that with PPE? We're going to do it with our net PPE, where the same way you learned in financial accounting, and we're going to expense that, right? That'll be depreciation expense. So here's what the journal entries look like. We say depreciation expense for 1/5 of the value of that mill, 20% of the mill, which is 10,000 in most circles. Okay, and then we're going to say here the credit net PPE 10,000. So remember, this is an asset, so we've just lopped off 10,000 to the value of this account. So on a balance sheet, how's this going to look? We're going to have just one line for our net PPE, okay, which is really nice. Okay, so after a year's worth of wear, this net PPE has declined in total book value from 50,000 to 40,000, and we just use the one line. And here's what you learned. What you learned in traditional financial accounting, you just keep that PPE constant. You have the pilot fish effect of the accumulated depreciation, which after 1 year is 10,000. And then you get to the third line, which is the important line, which is net PPE of 40,000. Okay, so what's the income statement going to look like? That shouldn't be 2008. That's a typo. That should be X1. So the income statement, you're going to have some revenue, some expenses, some COGS, etc. And we have depreciation here of 10,000. And this is exactly the way that you learned it in financial accounting. Okay, and that's because we go back to the journal entries, we have depreciation expense, which is what you always had there. Okay, so that's how that works. So in the homework for this chapter, you'll have a couple examples like the ones we just went through here, and I'll give you probably some other simple financial accounting problems to make sure that you remember the basics of your financial accounting, because as I said, we are going to be using it all semester. Okay, with that in our pocket, I've got another important note on the lecture handout. So this is the second one. The first one said anything in gray you're not responsible for. And the second one is that all of the appendices included in these lecture handouts are not going to be covered in our class lectures and are optional. So you are not going to be tested on the handout appendices. Okay, so here's an appendix, comprehensive review of financial accounting. If you don't remember your financial accounting, I strongly suggest you either look at this appendix, this review, which walks you through journal entries and then how to record a balance sheet, income statement, direct method cash flow statement, and indirect method cash flow statement, and or read the material in the corresponding Introduction to Business Finance textbook. Okay, so that's it for chapter 3. I'll look forward, as always, to communicating with you in the discussions, maybe seeing you in office hours, and then, of course, again in chapter 4. See you soon.